The following program paid for by Lifespan Wealth Management. Providing financial advice since 1993. It's time for Your Money with Sherry Goss, Randy Goss, and Jonathan Eisner. And now from the Macon studios of News Talk 940 WMAC, it's Your Money.
Good morning, Middle Georgia, and thanks for tuning in to Your Money, produced by Lifespan Wealth Management. As financial advisors, the main thing we do is provide retirement planning advice and manage our clients' investment accounts. So if you're looking for an investment advisor, call our office at 478-922-8100 to set up your complimentary consultation.
Lifespan Wealth Management has offices in Macon and Warner Robins for your convenience and has been serving Middle Georgia for over 30 years. You can learn more about our services by visiting our website at retirerelax.com. And while you're on our site, go to the special reports section where you'll find several reports that are available to you for free. You can also sign up to receive our digital feeds, which are short videos providing great information relevant to retirement, investing, and matters that affect your money.
We also offer seminars to the community at no cost. So if you're in need of a guest speaker for your church or civic organization, give us a call, and together we can decide what topics you would like us to present to your group. Again, our contact number is 478-922-8100. Good morning, Middle Georgia. It's great to be back with y'all again. And Jonathan's not with us today. He's out with a family doing something fun and exciting. So it's just me and Sherry. It's kind of like old times, Sherry.
That's right.
Yeah, it's nice to be back. Just the two of us. Well, jumping right into the markets, the U.S. stock surged Friday after Federal Reserve Chairman Jerome Powell opened the door for the central bank to cut rates as soon as at its next month's meeting. Speaking in Jackson Hole, Wyoming, Powell cited that inflation will continue rising and the labor market will keep weakening. He called that combination unusual and suggested it could prompt the Federal Reserve to support economic growth by reducing rates. He says the balance of risk appears to be shifting while labor markets appear to be stable. It is a curious kind of balance that results from a marked slowing in both supply and demand for workers. He also said that tariff-related costs will continue to accumulate in the economy, but for the first time, he suggested somewhat greater confidence that the effects of the higher good prices would be relatively short-lived. The Fed chair has faced intense pressure from the Trump administration to slash borrowed costs, and many investors already expect the Fed to cut rates next month, but had grown less confidence in that prediction in recent days after solid economic data and signs of quickening inflation. And right after the Powell's remarks, many stock indexes jumped more than 1%. The S&P 500 was on course to break a 5-session losing streak, its longest since January. And the 10-year Treasury yields and the Wall Street Dollar Index declined. Overseas markets were mostly higher, with gains in European indexes and Asia.
He is so easy to listen to and has such a great voice. And he also said that 2% is the target inflation rate, which is amazing.
Yep, we're getting there.
Very exciting for the economy.
We're getting there.
This week, Secretary Scott Bessent said the Trump administration is weighing plans to apply part of the tariff revenue toward lowering the national debt. He says he believes they are at a point where they are going to be able to do it. He said that in an interview with CNBC and added that he and the President Trump were laser focused on paying down the debt. The nation's debt, which is the amount of money the U.S. owes its creditors, is over $37 trillion as of August 21st, according to the Treasury Department. Horrible. The staggering figure has intensified the long-standing debate in Washington over government spending, taxation, and efforts to rein in the ballooning deficit. Bessent said he anticipates revising this year's tariff revenue estimate above the previous $300 billion projection. While he did not offer a new forecast, he emphasized the total would be substantially higher. According to the Treasury Department's latest customs and certain excise taxes data, the U.S. collected more than $29 billion in tariff revenues in July, the highest monthly total to date so far this year. Total tariff revenues have exceeded $156.4 billion. As the Trump administration touts rising tariff revenue, it's U.S. businesses that pay those higher import taxes to the federal government. However, the cost often falls on consumers as companies raise prices to offset the economic burden.
Wouldn't it be nice to go into the debt clock and see it going backwards for a change?
I would love to see that.
That would just be a great day.
That would make my day.
Yep. All right, so let's talk about how America's AI boom is squeezing the rest of the economy. And if artificial intelligence models have a hometown, it's probably Ashburn, Virginia, which is just outside Washington, D.C. This area is turning out to be the world's biggest cluster of data centers, and these centers alone consume more than a quarter of the power produced by Virginia's main electrical utility. Fears of an economic slowdown abound in America, with high interest rates and tariff chaos weighing on most of the economy. But they are doing little to reduce the breakneck pace at which firms are building the infrastructure needed for AI. Something like a sixth of the 2% rise in American real GDP over the last year has come from investments in computer and communications equipment, which include chips and data centers. Now, if you add in the grid updates to power the AI models plus the intellectual properties, value of the software itself, and one estimate puts the boom contribution to the real GDP at closer to 40%. And that's an astonishing figure for a sector that accounts for just a few percent of America's total GDP.
Absolutely. That's true, but the AI build-out is not a normal investment boom. Until recently, big tech firms paid for most of its expansion efforts from their earnings and cash piles. Today, the scale of construction is too great even for these giants, so they are turning to borrowing. They are building data centers in the belief that AI will drive explosive economic growth and hence demand for computer power, within a matter of years. This is not like building houses or factories. It is a high-reward, winner-takes-all market in which ordinary concerns such as the cost of borrowing are easy and tempting to wave away. And that is just what the big tech firms are doing. In the face of their determination to build AI infrastructure at any cost, higher interest rates are little deterrent. Neither does the cost of electricity. Schemes for gigawatt-scale data centers demanding as much power as a small city are increasingly in vogue.
Yeah. If history of the dot-com boom in the late 1990s is anything to go by, the mania could have much further to run. Back then, the rollout of costly technology required to build out the internet continued for many years, with a much sharper impact on GDP than America had experienced so far from AI. If anything, the early enthusiasm for AI has been even greater than that of the internet in its youth. For all the Y2K era excitement, few expected the web to lead to mass automation or unprecedented rapid economic growth. Both are now quite mainstream forecasts about AI among the Silicon Valley set. The trouble is that the very sector powering so much of America's economic growth is squeezing the rest of its output. House builders, for instance, cannot afford to be blithe about the higher borrowing cost. Data centers have also constrained the rest of the economy by keeping energy prices high. A case in point is that the average American electricity bill has risen by 7% so far in 2025, at least in part because of the extra strain on the data centers have put on the grid. Sure enough, look beyond AI and much of the economy seems sluggish. Real consumption has flatlined since December. House building has slumped, as has non-AI businesses investments. Both are highly sensitive to interest rates, and because of that, act as bellwethers for the output.
Okay, to sum this up, an economy-wide reallocation is underway. Interest rate and energy-sensitive sectors are contributing less to growth, while AI investment contributes more. And if it is to continue to do so, big tech firms must continue to increase spending. Any slowdown in capital expenditure, say if constraints on power or chip availability were to occur, it would mean less support for overall economic growth. But the silver lining is the rest of the economy. That should that happen, would be that interest rates and energy prices would probably fall too, easing the pressure on the rest of the economy.
Yeah. And Sherry, I'm not trying to be a Debbie Downer here, but history carries a warning. After the dot-com boom came a ferocious bust. A similar drop in AI investment would remove a big source of America's growth, just as the rest of the economy has begun to look fragile. Its desire for data centers cools. It's not just Ashburn, West Virginia, or Ashburn, Virginia, that might be in trouble. And right now, it's hard to imagine that now that we've uncorked the genie in the bottle, there will be an end to all this expansion. There will be, and we know that. But when is the question. I'm not sure if the Gardner hype scale or cycle applies to it here, but if it does, then we're still in the upswing. We're still climbing the curve upward. We are past the startups. We're past the first generation products and the early adopters. and we're possibly in the mass media hype and supplier proliferation, which rests right near the peak. The question that the Gartner model does not answer is the time between the phases on the x-axis. It will be interesting to see how this will play out and who will be the big winners when the music stops. Basically, those models are great, but you just can't get the time based on those. They could go on for 20 or 30 years. You just don't know.
Right. So Americans see their 401ks not just as nest eggs, but as rainy day funds. Americans are increasingly using 401ks as emergency funds, which has led to a record number of hardship withdrawals last year. During the pandemic, the average hardship withdrawal was about 2%. Last year, a record 4.8% of the 401k plans took hardship withdrawals. And more disturbing is that nearly 1/3 of people who leave jobs annually liquidate their 401ks, paying taxes and often penalties rather than keeping the money in a retirement account. What's more, Congress has repeatedly made it easier to raid these accounts. This adds up to a sea of change in how Americans view their retirement savings. The $12.2 trillion in 401k accounts isn't necessarily locked away, earmarked only for retirement income anymore. As people divert more of their savings to 401ks, the accounts are doing double duty as emergency funds. This 401k leakage has become so common that people often post about it on social media. A woman who said on TikTok that she cashed out her 401k savings to pay off debt reported being happy with the decision, despite paying taxes and the 10% penalty people under 59.5 years old typically owe. Policymakers argue that without early access, many Americans would be less willing to save for retirement to begin with. Proponents say early withdrawals can prevent problems from becoming crises that inflict greater damage on people's finances.
Yeah, and I get it. For many people, getting through today, this month, is the pressing issue. The savings will continue, but the crisis has been averted. The downside is that the early withdrawals threaten to reduce the wealth available for retirement by about 30% when the loss annual savings are compounded over 30 years, according to economists.
And about 40% of the working population isn't saving enough to maintain their lifestyle through their retirement to begin with. That's a massive problem.
That's right. And that's true. Also contributing to this leakage is the automatic enrollment, which has put more workers into the 401k accounts who might not have chosen to save. That includes many hourly workers who cash out and take the hardship withdrawals at significantly higher rates than the salaried employees. And that's because they need the money to live on now versus being put into the 401k. Thanks in part to the spread of the automatic enrollment, 82% of eligible workers now save in the 401k plans that Vanguard administers, up from 68% in 2007. The average savings rate is a record 12% of income, including employer contributions.
I don't believe that number. I cannot imagine that is the average savings rate nationwide.
Well, I mean, that's the data we have, so
I
we
know.
just got to
I
we
just
have to go with
question
it. I know, but back in 2018, lawmakers voted to relax the rules for taking withdrawals for financial hardships, which include preventing foreclosures, paying medical bills, and buying a home. These let people pull out what they need after taxes and often a 10% penalty. And in my opinion, if they're going to allow hardship withdrawals, they should waive the penalties if it's truly a hardship. So if it's a hardship, why penalize somebody another 10%? That's like adding salt to a wound.
I agree with you totally. Another law passed in 2022 has expanded the allowable reasons for hardship withdrawals to include being a victim of a terminal illness, domestic abuse, or a federally declared disaster. Such withdrawals are penalty-free in plans that allow them. That law also lets 401k savers take out up to $1,000 penalty-free for an emergency once every 3 years. Those who replace what they take out can tap their accounts again next year. The new law also lets employers automatically enroll workers earning less than $160,000 into emergency savings accounts. They can save up to $2,500 in a money market type fund in a Roth 401k and withdraw it tax and penalty free, which that sounds like a better idea, like a savings account that actually can earn money.
Right. And these emergency funds may help people avoid pulling money directly from their 401k investments. Vanguard found those with $2,000 or more in emergency savings are significantly less likely to cash out their 401ks or take hardship withdrawals. So, If you have the option as part of your 401k to have an emergency savings account, please take advantage of this feature. It will satisfy one of the big to-dos that we talk about all the time, that is the emergency savings, and it could save you 10% on early withdrawal penalties. And after all, a lot of people don't really think about it like this, but this is their hard-earned money, and they're
Right.
just giving away 10% gratuitously just because of a so-called hardship.
Right?
And if they had saved if they had saved a couple of $1,000s
In the bank.
in the bank, they wouldn't have to do this and save themselves 10%.
I agree. So that is great. So a lot of people come to see us as they want a projection of their future retirement income. So maybe this could help someone in your world get motivated to invest more and spend less. There is a great calculator that I use, and the website is calculator.net, and it is free. And here's an example of a retirement plan. And Randy, the print's too tiny for me to see without my glasses.
But I can read it. If you're, I'm sorry. If your current age is 35 and your planned retirement age is 67, and this calculator that Sherry talked about is really very simplistic.
Oh, it's so easy.
It's so easy. It's got just a few small blocks you got to fill in here. Your age is one of them. Your planned retirement age is one of them. Your life expectancy is one of them, and your current pre-tax income is another one. And then they assume your assumptions are your current income increases every year by X%. The income needed after retirement is 75% or whatever you think it's going to be of your current income. And then average investment return, we figured like 7%, and that's lower than the national average for the S&P 500. And the inflation rate, say, keep it at 3%. And then you hit calculate, and then it's going to give you a number. And it's really a neat little way for you to go
That's
through
great.
and take a look at what you think, what your retirement income is going to be.
So in this case, the projection was that the person needed to start saving more money to have enough money, that the amount of money that they wanted in retirement to take the kind of distributions they wanted to take. So see, this is something that I wish that the plan people that do the 401ks would go and educate people about this and say, let's do a projection based on your age, based on what you're saving, based on what the market's doing, and all of that. How's it going to look when you turn 65 and you go on Medicare and you retire? How much money are you going to have, and how much are you going to really be able to take out to live on? And I don't think anyone is talking about this. And so companies could just literally have somebody come and sit down with all the employees and say, let's just look at you. I mean, it takes like a minute to run this program.
But Sherry, this little calculator, there are a few things, I'm sitting here looking at it, that people might not have answers for. Like, what is your life expectancy? Well, unless you have gone to livingto100.com, the one that website we
Right.
talk about all the time, you might not know what your expected life is. But,
And it's always best to plan to live longer than you think.
yeah, and you can take a look at your family. You can take a look at, are they smokers and drinkers? Do they drive fast cars and live recklessly? And you don't. The other thing is, how much income are you going to need after retirement? You can take a look at your current income, and then
And your expenses.
and say, okay, if I'm retired, how much am I going to have to spend that I'm not spending today? Or how much am I going to spend in retirement that I'm not spending while I'm working? And things like that you need to just kind of work through. And the average investment return, you can look that up on the internet. If you're invested in an S&P 500 index fund, what is that traditionally over time? What is that earned? You can use that phone that's in your hand for a good tool and get the answers to every one of these. And you can look up what the average inflation rate is for the last 10 years on average. Just look it up. Now, of course, the last 10 years is going to be skewed by the inflation we had post-COVID.
Right.
And so that's going to skew things a little bit. But you can take that into consideration and maybe make the time frame a little bit longer than 10 years, right?
I like it. So again, the calculator site is calculator.net. It is free. They're not going to blast you with a bunch of ads and garbage.
Yep.
It is very simple to use. So share it with your family members. Tell your kids about it.
Yep.
And especially if they're just getting started investing, because then they can run a projection and they can see whether they're on track to be where they really want to be down the road. It's pretty fun. And they can go in and update it every year.
Yep. All right.
Alrighty.
You know, we always give you some news about inflation, but often it's not really good news. But today is a new day. We are going to give you some good inflation news. Economists are so busy hunting for signs of tariff-induced price hikes in the monthly inflation data that they may be overlooking some good news, which is that the surge in the cost of car insurance is finally abating. You have probably noticed in your own car insurance bill that the cost of owning a car has soared during the last few years, with drivers absorbing hits from all angles. The average cost of a new car is now $49,000 and is likely to push higher than that, and probably well above $50,000 with the tariffs. As new cars get costlier, so do used cars. Fancy new technologies and other factors have raised the cost of parts, repairs, and maintenance. But the biggest jump has been in the cost of insurance, up 60% in the last 5 years to an average monthly premium of $213. Ouch. That's a big bill that was once an afterthought, now totals nearly $3,000 per year, and a lot more for some vehicles and some drivers.
So he's not here to attest, but I know Jonathan is feeling the pain from this.
Yeah,
he's got
right.
a new teenage driver in his house, and he's told us how much fun that insurance bill is.
Right. And the accident fairy has not been kind to him either. Well, relief is on the horizon. In April 2024, the annual rate for car insurance inflation peaked at 23%, and is now much tamer at 5.3%. And the lower annual price hikes are likely to stick. In 2025, data shows insurers are raising premiums by 7.5%, significantly lower than the 16.5% increase in 2024 and 12% in 2023. Insurance is different from most other products and services people buy. Drivers buy insurance only once or twice per year, with the monthly premium set for the duration of the policy. Insurers set premiums based on car price data that is which also has a lag. They must also deal with regulators who may resist premium hikes that are also steep.
The recent surge in car insurance premiums dates to the first days of the COVID pandemic in 2020. Supply chain disruptions, such as the lack of semiconductors, sent new car prices higher, with used car prices soaring as buyers priced out of the new market shopping used. That means the replacement cost of a vehicle totaled in a wreck went way up. All the digital technology on new cars, such as cameras, sensors, processors, raises the cost of repairs as well. At the same time, global warming is causing more severe weather that leaves more cars destroyed in floods and storms. And for reasons researchers don't fully understand, crashes have been getting more severe. Well, drive down I-75 at 6 o'clock at night, and you can see why the crashes are more severe.
People drive like idiots.
Yep.
All right, here's another option. The $15,000 Toyota truck, and we've talked about this once before on this show. Road and Track has called it the basic transportation perfection. It is low cost, no frills truck that is a stark departure from today's large luxury technology-filled trucks on the market in the U.S. today. The overall exterior design is aimed to work with minimalistic design, square door openings, and easy entry and exit. The flatbed design with low bed size that fold down and small tires meant only for roads or dirt road driving. Inside the cabin is filled with plastic and rubber with small screens for the radio, crank windows, and not much else. The bed has bolt holes for various locations meant for bolt-on accessories. It can come in short or long wheelbase versions and with 3 engine options, 2.0 up to a 2.7 gasoline engines, and a 2.4 liter diesel if you want diesel, also a manual or automatic transmission. And I can't imagine how much lower the insurance cost would be for something like this, but I imagine it won't be a lot. But it will probably be cheap to insure compared with the say a Z71 Silverado or most vehicles on the road today.
Absolutely.
For that matter. So
Yep. Very smart.
You've been listening to Your Money, brought to you by Lifespan Wealth Management, proudly serving Middle Georgia for over 30 years. Our mission? helping folks just like you plan for a secure and stress-free retirement. Need a trusted financial advisor? Call us today at 478-922-8100 and schedule your complimentary consultation at our Macon or Warner Robins office. Want to learn more? Visit us anytime at retirerelax.com. Because when you plan smart, you can retire and relax. And here's something extra. We offer free educational seminars for the community. If your group needs a guest speaker, give us a call and let's make it happen. That's 478-922-8100. Now, let's get back to the show.
So, your credit score and income are better than ever, but your bank won't lower your credit card APR. Here's how to fight back. Credit card experts say that credit card companies are getting stricter about lowering APRs as economic uncertainty looms, but it's still worth it to call and ask for a rate reduction to cut down on your monthly borrowing costs. The interesting thing about, and by the way, you shouldn't carry balances month to month.
That's right.
I mean, if you didn't carry balances month to month, it doesn't matter what the APR is because you're not paying it, because you're not borrowing. You're just using it as a convenience item.
If you pay it off before that reporting date, you're safe.
Yep. The interesting thing about this article was that the author was working on a story about the credit card industry and realized he didn't know the APR on his own credit card, so he went to his bank's app to investigate. When he first applied in 2020 for the card he uses almost daily, it had a 0% APR for 9 months. He never paid attention to what the interest rate jumped to after that, so you can imagine his surprise when he found it was 27.24%. That's 3 percentage points higher than the average APR and nearly 7 points higher than the average minimum APR, according to data from LendingTree. An APR is the annual percentage rate of interest a borrower will pay on a credit card if they carry a balance into the next month, which I hope he is not.
Yeah, 27.24, that's crazy. Inspired by personal finance experts who preach the value of asking, he decided to call his lender, a top 10 commercial bank in the United States, to simply ask for a low rate. He informed the consumer service representative that he had been a card holder for several years and has never missed a payment. After the rep put him on hold for about 10 minutes, she told him no. There weren't any offers available at this time, and this was the lowest APR the bank was able to offer him. Undeterred by his setback, he decided to seek advice from Matt Schultz, the chief consumer finance analyst at LendingTree, who wrote a book about how to ask questions that can help you save money. In response, Schultz asked him a few questions about his current financial situation that could strengthen his case. He told him over the past year, his credit score had increased by about 100 points after paying off several $1,000s in debts he accrued on the card while he was in graduate school. His income had also doubled in May when he transitioned from working part-time as a student to landing this full-time job at MarketWatch. Schultz told him that he had a strong case and recommended he call back to ask again. This time, he said, you should tell them that you wanted to provide more information you didn't think to share initially to show that your financial situation had dramatically improved. So he called again. After he explained to the consumer service representative why he was calling again, he followed the script Schultz gave him. 2 things. First, my credit score has dramatically improved since I initially got the card. It was around 680 a year ago, but it's at 777 today. Second, my income has increased significantly, doubling in May when I started a new job. It is currently X. I am pretty proud of both of these things, and given that I've almost fully paid off my current balance in the last 6 months, I think it's a responsible request to ask for a lower interest rate. The answer was still no. Congratulations for all these improvements that you've had on your credit record at this point. And that's excellent, said the customer representative. That's going to help you have a really good credit at this time, the representative told him over the phone. But keep in mind that when it comes to the interest rate, this is the one that's based on prime.
The prime rate is an interest rate used by banks as a base for setting rates on loans and lines of credit. Lenders add a margin to the prime rate to determine a card's APR. The rep continued, we use this amount of the prime rate to determine the changes on the interest charge, but unfortunately, we don't have any offers available to lower the interest rate we charge you. They went back and forth for a bit before ending the call. He pointed out that the APR range the issuer advertises for the card starts at 19.24%. The rep told him this was an introductory rate, which he later learned wasn't necessarily true. On the bank's website, where you can apply for the card, it says there's a 0% introductory APR for 15 months and 19.24 variable APR after that time period. A few days later, he tried again and even said he was considering taking his business elsewhere. The bank never budged. Data suggests he's among the minority of people who are told no when asking for a lower APR. A LendingTree survey found that 83% of cardholders who asked for a lower credit card interest rate over the past year got one, the highest success rate since 2021. But as the prices of goods and services continue to rise and a September rate cut by the Federal Reserve isn't set in stone, which that changed today, experts say lenders might be tightening their belts as they wait to see how the economy moves in the coming months.
And I think that's really the bottom line. And Dan Simmons, the Senior Director of Consulting and Financial Services at TransUnion, says that the credit card issuers are generally open to negotiations, and this is especially true for consumers who show willingness to pay and a proactiveness in communicating with their lender. However, they've been approaching negotiations with more caution given their uncertainty in the economic environment. In fact, some banks have been raising APRs on credit cards even as the Fed has kept the benchmark rate steady. A lot of forces are at play when it comes to credit card issuer decisions. NerdWallet credit card expert Sarah Rathner says that it could be forces that are beyond your control, such as inflation reports, tariff repercussions, interest rate decisions by the Fed, and other macroeconomic pressures. Another option you should consider is a balance transfer card. This can be a good idea if you have a clear plan to pay off the debt while the APR is zero during the introductory period. Borrowers can apply for multiple balance transfer cards to see which ones offer the highest credit limit and call the card companies after approval to ask for a higher limit. It is important to know that you typically need good to excellent credit and a steady income to qualify for a balance transfer card, and they typically come with a transfer fee of 3 to 5% of the balance that you're transferring. Experience says that a good credit score ranges from 670 to 739, while a very good credit starts at 740, and an excellent score starts anything above 800.
One option for consolidating high-interest debt is taking out a personal loan with a fixed rate, which is often lower than credit card APRs. This can be easier to pay down because it's a fixed monthly payment over a set period of time, unlike open-ended credit card debt.
Yeah, and the bottom line, pay your bills on time every month and don't carry a balance on your credit card. Also be sure to track all of your debt to income ratios, or the DTI, because this is how lenders look at you when you come to them requesting to borrow or take out a new credit card or a line of credit. The following are percentages of debt that you may be carrying or that you carry. And I got this from the Wells Fargo site. And here's how they look at you when you come in and apply for a credit line of credit. If you have a 35% or less debt to income ratio, you're looking good. Relative to your income, your debt is managed at a manageable level. You most likely have money left over for savings or spending after you've paid off all your bills. Lenders generally view a lower DTI as favorable. And a 36 to 49% DTI, opportunity to improve. You're managing your debt adequately, but you may want to consider lowering your DTI. This could put you in a better position to handle unforeseen expenses. If you're looking to borrow, keep in mind that lenders may ask for additional eligibility criteria. And if you have a 50% or more DTI, take
Ouch.
out. Yeah, you may have limited funds to save or spend. With more than half of your income going towards debt payment, you may not have much money left to save, spend, or handle unforeseen expenses. With this DTI ratio, lenders may limit your borrowing options.
So when I was young and I got my first credit card, I wasn't making very much money, and I had an $80 credit limit on my credit card.
Yeah.
And I had no other loans. I paid rent. I had a car that I owned. And a job. And so over time, I have watched the amount of debt they're allowing people to take out to be just exorbitant. And it's wrong. I mean, we should have rules about how much you can actually borrow, and then drop on top of that, buy now, pay later. I mean, this is a disaster.
And the bad thing about the buy now, pay later is that a lot of these are not reported.
They're
just starting to report them, but still.
But you've got to get a grip. You can't. I meet people who are going to retire within a year, and they owe so much debt that I have to tell them, you can't retire. You've got to keep working. You've got to pay this stuff off. You can't live on what your retirement income is and have to pay all these bills.
You know, the debt to income ratio is a very simple calculation, and it's something that if people just live by it, they would be so much better off.
They would. But yeah, before you retire, please pay off your debt because you'll be in so much better situation. You'll be so much more relaxed,
And I would
so
just-
much less stress.
And I would say just live by the DTI throughout your life, and,
Right.
and you'll be so much more relaxed, and you're not worried about bill collectors calling you when you get off work every night.
Right. Anyways, moving on. What should I do if my neighbor's tree is about to smash my roof and fence? Question. My neighbor has a rental that has a dead tree leaning over toward my house, ready to take out my fence and roof. The neighbor lives out of state and I don't know them. Answer. In this case, he needs to document.
Yep.
Otherwise, if that tree comes down via a means that may seem natural, he could be responsible for any damage to his own property. He must document that his neighbor's tree is visibly diseased or dead. Then the neighbor is liable because they've been negligent for the damage that occurs to your house and your property.
Yeah, and what a lot of people don't understand is when a tree crosses the property line, it is your tree.
I had never heard of this.
You remember that tree that fell on our property at Thornton Boulevard? It was a giant tree. Came over and smashed our pool pump and everything else. That's what the insurance company told us. It's your tree.
Oh, I forgot about that.
Yeah.
Wow. Anyways, then the neighbor is liable because they've been negligent for the damage that occurs to your house and your property that would normally be your problem. Here are 3 steps. 1, take pictures. Use your smartphone because the photos will automatically get time-stamped on your phone. Make sure to capture visual evidence of something wrong with the tree. 2, ask the neighbor to take it down. If you can't reach them by phone, ask your neighbors if they have their address. 3, mail a certified letter. This provides proof that you have notified them. Another point, you have no idea what kind of coverage this individual has. They may not be carrying insurance on the property at all if they own it mortgage-free.
Right.
And personally, I would have never thought of that.
Yeah.
I just assume everybody buys insurance.
People have different standards on how they think is what is right, But, to get the address for the person, if you don't know them, you can look them up in the county tax records, and from there you'll find their address. And you can send them a certified letter. And I would say if the owner doesn't reply in 30 days, send them a second one. And then you might need to get an attorney involved if you don't want to have the tree removed yourself. But in either case, you're going to end up spending money on an attorney or a tree company, one of the two. But I would rather. You're going to end up spending probably more on the attorney and everything
Right.
else. So if you can get in touch with a guy, maybe
For
there's some-
$500 to cut
Yeah.
the tree down?
Well, maybe tell the guy, if he's not willing to cut the tree down, maybe you'll split the difference with him or something. I mean, because if the tree hits your house, you're going to be out a lot more than just the money.
Right.
I mean, there's a lot.
Plus, your insurance premiums are going to go up
Well, no, not
because you'll have a claim.
Well, probably not. I mean, it's someone else's tree that hits your house. It
don't
does an
know.
act of God, maybe as a termite or a lightning strike or something that made that happen. But maybe not. But still, you're going to end up spending a lot of time in a hotel if a tree falls on your house.
Right.
So anyway, retiring early, prepare for higher healthcare premiums. If you are retiring early and expect to buy health care insurance on the Affordable Care Act marketplace, brace yourself for higher premiums. Individual market health insurers are requesting the largest monthly premium increases in more than 5 years, according to the nonpartisan health policy organization Peterson KFF. The organization says the median monthly premium increase will be about 15%, spurred in part by the extra federal subsidies for premiums expiring this year, and tariffs may make drug costs more costly. Financial advisors say there are a few options to keep healthcare costs down for people who want to retire before they go on Medicare at age 65. It takes planning, careful management of cash flow, and a focus on tax planning. Congress has until December 31st to extend the enhanced tax credits. If they expire, tax credits will revert to the basic tax credits, which limited income eligibility to 400% of the federal poverty level, which is around $62,000 for single persons. The enhanced tax credits cap how much someone has to pay for health insurance up to 8.5% of their federal income. KFF says the subsidies will expire. If the subsidies expire, 51% of the current enrollees aged 50 to 64 will lose their subsidy eligibility.
So one strategy for early retirees over age 59 and a half is to tap Roth tax-free individual retirement accounts to keep their taxable income low. Financial advisors normally advise waiting as long as possible to tap Roth accounts to let those tax-free savings grow. But some early retirees can come out ahead by spending down the Roth now to avoid big healthcare premiums. Planning ahead for healthcare costs in early retirement can also keep taxable income down. For example, if you want to retire at age 63, consider putting 2 years of cash flow needs in a high-yield savings account. That way you won't have to tap tax-deferred accounts where any withdrawals are taxable income. You could also consider selling assets before you retire so you can avoid capital gains that will lift your taxable income and insurance premiums when you need to buy health care on the exchanges. If you've been able to fund health savings accounts while working, start spending down this money in early retirement. That will allow you to pay for certain healthcare costs tax-free, though not health insurance premiums. Pairing HSAs in a taxable account gives early retirees flexibility if they're trying to keep their income low enough to qualify for the stricter income eligibility limits under the ACA's basic tax credits.
And early retirees who are moving to new states need health care should carefully look at the health care options and costs on the exchange between the different states, as these can be significant. If you are retiring early because you have had it with your current job, you could possibly find a lower paying, less stressful job in a field that includes health care coverage and enjoy the change of pace as well.
I like that.
Yep.
Like being a checkout person at Kroger. Whatever you choose, don't forgo health care coverage at this stage. There is too much risk, especially for people who are right around retirement age. I refer my clients who are retiring earlier than the Medicare age to contact Heart of Georgia insurance brokers in downtown Macon. Their number is 478-745-4741. And they also have an agent that helps you determine which Medicare program is best for you if you need help with that. So for me, that is right around the corner. But back to the Kroger comment. I had a guy come in to meet with me with his wife, and he's still working at Kroger. I just saw him the other day, and he's like 70 years old, but he just likes the cash flow, and he likes being busy. He doesn't like being bored and just sitting around. And he said their health insurance is just amazing. And, I mean, he doesn't make that much money, but it's worth it to work just for the health care.
Yeah, why not?
So,
all right, more good news here. Scientists are finally making progress against Alzheimer's. 60 may not be the new 40, but 80 could soon be the new 60. A trove of new Alzheimer's research suggests that medicines and lifestyle changes can not only slow but prevent, even reverse, the debilitating disease. Alzheimer's is characterized by a buildup of amyloid plaque and tangles of tau proteins in the brain. They trigger inflammation, which in turn causes cognitive declines and neuron death. Scientists don't exactly know what causes the destructive cascade. The disease's complexity stymied the quest for treatments for decades, but no more. Scientists are learning quickly. The only two approved treatments for Alzheimer's that can slow progression, one is developed by Eli Lilly and the other by Biogen.
I don't even know how to pronounce that.
SE, I guess, work to remove the amyloid plaque. They reduce the cognitive decline by 25 to 36% over 18 months compared with the placebo group in clinical trials. Those in the earliest stages of the disease saw bigger benefits, and nearly half of those on the Lilly trial showed no progression after a year. Some scientists who don't treat Alzheimer's patients dismiss such benefits as not meaningful, but the medications can mean more years when your mother recognizes you. Who wouldn't find that meaningful, right? Recent follow-up studies have also shown that benefits grow over time, doubling over 3 years for Eli Lilly's treatment and quadrupling over 4 years for the Biogen drug. Drug makers are studying whether eliminating amyloid can ward off Alzheimer's in preclinical patients, those without cognitive symptoms, as statins can prevent cardiovascular disease.
Lifestyle changes can augment the benefits. A recently published randomized trial found that a treatment of regular physical and cognitive exercise, nutritious diet, and social engagement improved cognitive performance among previously sedentary older adults at risk of dementia. A small study earlier this summer found such lifestyle interventions improve mental acuity of early age Alzheimer's patients, as well as physiological measures of brain health. Why is this notable? Studies have found that microbiomes of Alzheimer's patients differ from those of healthy seniors. For one, Alzheimer's patients have lower levels of bacterial strain that produces the short-chain fatty acid propionate from dietary fiber. Propionate helps regulate appetite as well as brain inflammation and amyloid buildup. In one study, propionate was found to reduce brain inflammation and amyloid in mice with the rodent version of Alzheimer's disease. So perhaps a probiotic cocktail or more fiber in the diet could slow progression, much like anti-amyloid treatments. Another potential antidote, lithium salts. A study published last week in the journal Nature found that amyloid can trap lithium, resulting in a deficiency of the mineral. Lithium protects neurons. Mice given a lithium-deficient diet had more amyloid, damaging neurons, and impaired learning and memory. A low dose of lithium orotate reversed cognitive problems and restored memory. We won't discuss the entire article, but this is some really good news on the subject of Alzheimer's. This is a terrible disease and one that we at Lifespan Wealth Management would love to see solved. We often see people who have prepared for their retirement their entire working life, only to have their best laid plans wrecked by Alzheimer's or dementia.
That's right.
So we applaud these efforts. And if you have relatives who have been diagnosed with Alzheimer's and are concerned you may be on that path, call me at 478-922-8100. I have a client that is going through a 2-day study at Navicent, which will tell him whether he is on the path to Alzheimer's. Once he finishes the study, I'll get more details for those of you who want them. So just call me if you want that information.
This is really good news. All right, U.S. allies are still waiting for tariff relief on auto and steel. In return for billions of dollars of investment pledges and promises to buy more American goods, U.S. allies in Asia and Europe say President Trump agreed to lower tariffs on key exports such as cars and steels. Weeks later, they are still waiting. Earlier this year, Trump threatened many of the U.S. trading partners with lofty import duties. Then, in a rapid series of deals culminating this month, he lowered them in pacts that in some cases included pledges by those countries to invest in the United States. The administration, however, has so far left in place a series of tariffs levied for national security reasons on sensitive products such as cars, steel, and aluminum. The delays in addressing those tariffs, as well as the discrepancies over investment and other issues, have created uncertainties for businesses and policymakers over the future U.S. trade policy. Japan and South Korea said agreements they struck with the U.S. include a reduction to 15 and 25% tariffs on imported automobiles, but for now the levy is still being collected, adding to the mounting losses of some of the world's biggest car makers. Toyota Motors estimates tariffs will cost around $9.5 billion in lost operating profit for the fiscal year ending in March, an estimate that had assumed tariffs on U.S. car imports would be reduced this month.
Even the UK, which was the first country to agree to a new trade pact with Trump back in May, is still waiting for a reduction in steep tariffs on steel. The two sides are thrashing out final terms on exactly which UK steel exports will qualify. A U.S. administration official said the U.S. agreed to discuss and possibly adjust these so-called Section 232 tariffs, but said the administration didn't make a firm commitment to change them as part of their initial agreements. These problems illustrate the challenge of putting Trump's rapid-fire trade pacts into practice. Traditional trade agreements run to hundreds of pages and seek to define clear rules for cross-border commerce to encourage companies to take the risky step of engaging in international trade. Trade lawyers painstakingly haggle over tariffs and regulatory barriers to broaden market access. Trump, in his second term, prefers bold pledges and handshake agreements to detailed legal texts with binding commitments. His trade policy is less about expanding international trade than it is about narrowing chronic U.S. trade deficits and recouping what he believes are billions of dollars lost to foreign countries under the existing global system.
Yep. Trading partners, too, have shied away from the formal agreements that would impose specific legal obligations on their side. That partly reflects the desire to avoid bureaucratic entanglements and move swiftly, according to analysts and government officials, as well as the wariness of Trump's commitments to agreements he does make. Trump, in his first term, signed new trade accords with Japan, South Korea, Canada, and Mexico, among others, all of which he has effectively repudiated by unilaterally raising tariffs. Answering critics in Japan's parliament who wanted to see a written version of Tokyo's trade pact with Trump, their prime minister told lawmakers a formal treaty would mean even greater delays in implementation, without a guarantee that Trump would stick with it. The EU is pushing for a written statement, but has said it won't be legally binding. Commerce Secretary Lutnick says that documents with deals and terms for the countries, including Japan and South Korea, are just weeks away, but that investors shouldn't expect a 250-page trading agreement. Unlike the stability and the confidence building brought by traditional trade deals, this new, looser approach to trade policy means delays, disputes, and misunderstandings are the new normal for trade relations with the United States, said Simon Everett, and he's a professor at the IMD Business School in Switzerland who runs Global Trade Alert, which monitors trade policy. He says that the upshot is that we inject uncertainty rather than remove it. And it's the price you have to pay with Washington these days. And I'm not sure I like the uncertainty angle here in this. I'd rather not have the uncertainty.
Yeah, I don't like uncertainty at all. Well, an administration official said the documents being prepared will more precisely lay out deal terms and put to bed any lingering uncertainty, but did add that the president reserves the right to adjust tariff rates if he judges the other side has reneged on its commitments. As well as Japan, South Korea, and the EU, the U.S. has also reached preliminary agreements with smaller but significant trade players such as Vietnam. A deal with China has proved tougher, but Trump this month extended a deadline for higher tariffs on China to come into effect to allow further talks and a possible meeting with the leader Xi Jinping. The typical format for a Trump deal includes a pledge by the U.S. trading partner to invest big sums in the U.S., promises to build more American exports, and a lower tariff rate in return. Almost as soon as some of those pacts were announced, cracks in what exactly they entailed started to show. Following a deal with Seoul, the White House announced that South Korea would provide historic market access to American goods like autos and rice. Yet Finance Minister, I can't pronounce his name, one of the South Korea's top trade negotiators, told reporters when he returned home that he didn't discuss rice with the U.S. team at all. An administration official said White House announcements have laid out what trading partners have agreed to, and we expect them to abide by these commitments. Investment pledges have proved especially controversial, with U.S. allies pushing back on Trump's insistence that he will have considerable discretion over how these funds are invested.
Yep. For instance, a $350 billion investment fund that was the cornerstone of the pact with South Korea, of which $150 billion is earmarked for shipbuilding, would be owned and controlled by the United States and selected by himself, as meaning Trump. Kim Yong-bom, South Korea's presidential chief of staff for policy, said that the fund is not a structure where the U.S. unilaterally decides, and that South Korea will also require the investment projects proposed by the U.S. to be commercially meaningful. Japan's top tariff negotiator flew back to Washington only days after striking Japan's trade deal. In meetings with Trump officials, he protested that a July 31st White House executive order seems to stack a new levy of 15% on top of any new pre-existing tariff on the United States imports from Japan. He had told Japanese lawmakers that the 15% wouldn't be piled on top. He ultimately returned with a commitment from the U.S. officials, he said, to revise the order. The U.S. has agreed not to stack on new tariffs for Japan, although the officials added that this wasn't part of the deal Japan had initially negotiated. The EU is also waiting for relief on auto tariffs and is negotiating improved terms for steel production or for steel producers. Asked about the vehicle tariffs recently, an EU spokesperson said the U.S. has made political commitments to them in respect, and we look forward to them being implemented.
This whole tariff thing is just amazing to me, and the number of negotiations that are going on. I've never seen anything like it in my life.
I haven't
and
either.
How many people are involved, and how many people are coming to the table, and how many people are working on trying to figure out what's right, what's fair, what's this.
How would you like to be the person trying to keep track of all the stenographer, basically keeping track of all this?
I want to know how you deal with Trump throwing a tariff on, and then he takes the tariff off, and then he throws it back on. I don't even know how a country deals with that, or how you even adjust how you do that. I just find it kind of crazy.
It's the people at the ports that they have to, change
punch the buttons.
punch the buttons, make it all change.
Oh my gosh,
So,
we're living in a really interesting time, though.
That we are.
And it's very fascinating that we're finally going to have income from tariffs that could potentially pay down
Some of our national debt.
which is just amazing to me.
That's a phenomenal thing.
I'll put up with the chaos as long as the results work.
Yeah,
How about that?
As long as we don't take off all of our friends
There we go.
worldwide, that is the thing that I don't want to have happen.
Absolutely.
But I don't think that is going to happen because they do like having us as a friend ultimately.
Yes.
Anyway, everyone, we thank you for tuning in and taking time out of your busy Saturdays to be with us, and we always appreciate each and every one of you. So
Have a great weekend.
Thanks for listening to Your Money, produced by Lifespan Wealth Management. As financial advisors, the main thing we do is provide retirement planning and advice and manage our clients' investment accounts. If you're looking for a financial advisor, please contact our office at 478-922-8100 to set up a free consultation. You can learn more about us by visiting our website, retirerelax.com. If you have a question or topic you'd like for us to address in a future broadcast, email Randy at rfmoney.com. We look forward to connecting with you next week. Have a great weekend, everyone.
Securities and investment advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC. Osaic Wealth is separately owned, and other entities and or marketing names, products, or services referenced here are independent of Osaic Wealth.